Hey, good morning.
Hey, good morning, hermano.
¿Cómo estás?
Bien, ¿y tú? You look fresh.
Oh, yeah. I'm good, man. I don't necessarily feel that way.
How's your weekend? You ready to let everybody in?
My wife can see it.
Yeah, man.
Recording
Yeah.
in progress.
All right, let me get the screen going here. It's the top of the hour. Welcome, everybody, to Snipers Live. I've got a bit of a sore throat. I had a Bumble date this weekend. I don't think it was a good call. Anyway, let's get going here. Stock, crypto, and options trading has large potential rewards, but also large potential risk. You must be aware of the risks and be willing to accept them in order to invest in the stock, crypto, and options market. Do not trade with money you cannot afford to lose. And this is neither an offer to buy, sell, or recommend a particular stock, crypto, or option. Let's do a market update. It's exciting. People are running through the hills. The sky is falling. The sky is falling. The market is crashing. Not too far from the truth, quite frankly. And we're going to talk about all of this right now. And I'm going to be getting to the futures a little bit. But I wanted to show you an article. I usually get up a little before these. I get up a few hours, and I'm just kind of scouring and looking around. And I found this. It's not really funny, but it's the languaging is funny. This is right on Bloomberg. The hideous strength of the U.S. dollar.
Yeah, you're right.
So somebody have a question or a comment? Okay. This is a big deal. So what's going on is the U.S. is fighting inflation by lifting interest rates harder than other countries. And what that has the effect of is to create a super mega strong US dollar. So this is really kind of a perfect storm of bearishness. So when the US dollar gets stronger against foreign currencies, what do you think that does to people in foreign countries that want to spend money on US products, US oil, US gold, US products? All of that has a dampening effect. So the US dollar on Friday gapped up big, like all the way up to 30. This is the UUP. It's the ETF that tracks the strength of the US dollar. And I wanted to show you something in Tom's tools. I do this from time to time, and I wanted to make sure everybody knows how to do this. So what I want to show you very clearly in a stock chart is the impact of the US dollar, the strength of the US dollar against gold, silver, and oil. And all of this spells opportunity, which is why I'm doing it. That's why I do anything on these calls is what's the opportunity? How can we make money? Let's get some more days on a chart here. And so I'm going to put up here the UUP in the charts. I'm in stock charts, as you all know. And what I want to do is come down here to symbol overlay, click on not paired. And let's take a look and see what the UUP has done to, let's just say gold. Now, if you don't know, gold gapped down on Friday. This is gold. The black candles are gold. Here's the US dollar. Gap up in the US dollar, gap down in gold. Now it's not confined to just gold now. It's also confined, or it's also present in oil. And so some of you in the hedge fund course, we had a trade on USO and it gapped down. All of a sudden, oil's down here. Why? Well, US dollar got stronger. And so when you start thinking about this, we've got a global high interest rate, a global inflationary environment. Interest rates are rising faster than in the US than they are in other countries, creating this issue with the US dollar driving down commodity prices. We've got joblessness. The jobless rate is high at the moment, which is an outcome of of high inflation. And then if it keeps going, the Fed lifts, we have recession, maybe a global recession. So really, all of this is, this is kind of a joke, but it's the reality. And with all of this, the reason that we even look at this stuff is to get a solid, let's call it a guess. It's a guess, but a solid guess, a prognosis if you want to get technical. But when we're predicting the future, it's down. It's down. Markets down. Gold down. Commodities down. Stocks down. And you can see it very, very, very clearly in a chart. Here's the futures. Let me give you this real quick here. Gerardo, if you could tag futures in the Fathom. My brain is a little is a little choppy this morning, so I'll get myself together here. I'm not feeling too well. So we're going to look at the pre-market. Tom's Tools isn't available. We don't have data until 10 o'clock Eastern. So we're going to look at the futures now, and let's take a look and start to get a prognosis and develop further, stronger prognoses about what's going to happen next, what might happen next. Here's the E-minis, the S&P 500. And, we talked last week about this being a strong floor here, and we're there. So we called this pretty much since 3,900 was broken. We said 30, around 36.5, 3,700. That's where we are. Futures are down a little bit to open the day. Futures volume, the red volume is far more frequent and higher than the green volume. Those are called distribution days. Further downside, we are at a very pivotal point at the moment. If we do crack below this low here in particular and close there, then God knows where we'll go next. We can get a longer term view. Let's just do a 3-year weekly chart. So this is weekly, and Andrew was pointing this out before. 3,600 is mega strong support. Okay, so this is a 200-month moving average. So don't get too excited about that level there, but we're right here. So where do we go after? Well, then what you do is you look over at prior peaks and high and low peaks, and you find the next level of support, which to me looks to be somewhere in the 3,300 range. So I think it's quite conceivable. Maybe here, 3,400, 3,300. So that appears to be where we're headed next. Of course, we always have these inflationary reports that come out. We've got one coming out this week. If you go into Market Watch, you can see there's going to be inflationary and jobs reports pretty much every week. So shy of going in there and showing them to you, they're happening this week. So that's you got to watch out for that. We could see a bounce if there's any report that indicates that inflation is getting better, abating, getting less, and we could always see a pop up. But when you consider the threat of even the idea that there might be a global recession, your prognosis has to be down. Or certainly maybe it's not up very much. Maybe that could be your prognosis where you say, I just don't think the markets are going to go up that much. If they do bounce, it'll be short-lived. So so for me, this environment screams. Let me poll everybody here. Let me get you involved this morning. What sort of, one more thing. I'm going to lead the witness here with a piece of information. Look at the VIX. The VIX. Remember, I was saying last week, yeah, I'm a little bit, the VIX just doesn't want to get above 28. Well, it happened. The VIX right now is at 32, the VIX futures. So let's find it here at /VX. VIX futures are pointing to 30.6. So now we've cracked 30. Looks like we might have further upside in the VIX, meaning the market is starting to buy. Hey, man, we're in trouble. This market could crash further. VIX is reflecting it. Options are expensive. Looks like the market might drop. Doesn't look like it's going to go up. What strategy screams, trade me, trade me? Let me pause. Let me see some of your faces. What kind of strategy should we be looking at, do you think?
Sal premium.
Sell premium, Leo says in his SUV. Where are you going, man?
Doctor visit in 45 minutes.
All right.
I will leave earlier.
Yeah, I like selling premium. And what's the best way for us to capitalize on our, let's call it our directional prognosis, which is not up or up if it is up a little bit.
Sell calls.
Yeah, man. Sell call spreads, screaming for us to trade them. This is ideally the environment. This is the ideal environment. When COVID happened in 2019, was it 20 or 19? I can't remember now. 19. I was killing it. I was just selling credit spreads with this global pandemic and the fear markets were dropping and bouncing and dropping and bouncing. Credit spreads, you know, that was one of my best months, February, March of 2019 when COVID hit was my, or was it 20? I can't remember. That was my biggest, one of my biggest months ever. And what I was doing was selling credit spreads. So that's where I want to lean today. And I'm happy to look at anything that you all are looking at. If anybody has any comments about what they think is happening in the markets, we could look at that too. And while you're thinking about anything you want to share, you know, oil is taking it on the chin. Now this is, we have our death cross here. This is the futures for oil /CL. This is live. This is live data. And crude oil is now closing below 80. So further downside. And if you think about it, U.S. oil is more expensive. Recession is believed to be a coming. Inflation is there. Are people going to buy less oil globally? Yes. And you're seeing the impact of that here. So decidedly bearish prognosis on oil. This is, you know, to me, this is exciting. I love these markets. I have to kind of like stop myself from getting too excited because, you know, although it's really not good for investors and the world is suffering a bit, you know, it's from a trader's perspective, it is the very best environment for us to make money. Have you ever heard the saying, bulls climb the stairs and bears fall out the window? You know, that's kind of it. And so we're gonna profit on this in just a minute. Let me take a look at a couple other things. I didn't show you the gold chart. So gold, it looks like it might get a bounce today. We'll see what happens. This is a daily chart. Let's do a longer term chart, a monthly chart, and let's try to get a feel for where gold might stop dropping. Where's support? Wow, this 1700 level was so important. That's the gold hadn't closed below 1700 since you know, right up in here, which was June of 2020. So we're setting lower lows. So then you just look to prior peaks and valleys, and you know, you might see, you know, I would say gold 1500 would not be too far-fetched if the US dollar keeps rising, and we're going to raise our interest rates even more. So the chances of that are very high. Now, on the other side of the coin though, so there's the pressure of US dollar rising, driving gold down. And then on the other side of the coin, if the markets really start to correct even harder, then at some stage, and maybe it's today, I don't know. It looks like maybe today. We'll look at a little bit later. Certainly through the rest of the week, I'll be looking at this. But this may be a sign of risk off, money flowing into gold, because gold is safer than any stocks right now, that kind of thing. Bonds, what are bonds doing? Let me find there it is. Bonds are dropping with rising interest rates. So again, with bonds, you might, well, at some stage, bonds will become more attractive. They're paying more yield with rising interest rates, and temporarily at least, or well, not temporarily, for a while now, bonds have been dropping with rising interest rates, but at some point, money's going to flow into bonds because they're safer than stocks. Risk off bonds are also a risk off instrument. So both gold and bonds will at some stage bounce, and money will flow in if we do reach a risk off environment. But I don't see one currently. I thought I saw one last week, but we're going to keep an eye there.
Hey,
all right.
Hey, Mike.
Yeah.
On bonds with the Fed buyback, in full swing, wouldn't that also be another driver for the bond market as well?
Yeah, yeah, it would be. So that's our environment. And it's a bit like, you know, those money, you ever seen those game shows where they stick somebody in a booth and they, with money in it, like a phone booth, and then they blow wind and there's money flying everywhere? It kind of can feel like that. There's so much opportunity. And so what we want to do now is to narrow our focus on the lowest hanging fruit. And in this case, the worst performing sector. The market is decidedly bearish. Let's find the most bearish sector. And then let's find the most bearish stock or stocks in that sector. All right, that's what I want. It's called top-down analysis. And it is really about picking off or sniping the best profits. Let me talk to you about my sniper system. And this is the reason this let's call it a course, whatever you want to call this, live trading course is called Snipers, because on its inception, it was all about finding credit spread opportunities and sniping the profits from a distance, a safe distance, grabbing profits. That's the idea. And Gerardo, let's put a tag on this sniper system. So what we look for is stocks that have moved big, like big moving stocks, and they've moved on either good or bad news. Really good news or really bad news is best. And then what we do is we'll sell a credit spread at either support or resistance. Support if it's good news, and resistance if it's bad news. All right. So in this environment, I'm most interested in bad news. Here's some bad news. The US dollar is rising so precipitously that Bloomberg called it a hideous rise in the US dollar because of the impact on the global economy. That's really bad news. Really bad news. So I'm going to look for that. We're going to look for some bearish credit spreads, and then we use 7 to 14 day options, short term. This is not long term, although long term credit spreads right now out of the money bear calls make a lot of sense, a whole lot of sense. Maybe we'll spend some time on those in a minute. All right, so that's the sniper system. That's why this course is called Snipers. It's primarily looking at probability, high probability profits, looking for technically interesting stocks that break down below support, or break above support, break down below resistance, and there's news to keep the stock from recovering, from either dropping if it's bullish or rising if it's bearish. So there's good news to keep it in place, and then we come in and we snipe some profits. So that's a distinction that I like. It's real world. Now, how do we figure out sectors? What was it? Francis. Yeah, Francis talked about FinViz on one of our calls last week, but this is a really cool site. It's called Sector Spider. Most everybody here has seen it, but I'm going to review it again. Tools, Sector Tracker. It's just free. And then you can go into various time frames. I'm going to go into 1 month just for now. And so this 1 month, what it does is it gives you all the Sector Spider ETFs, exchange traded funds that track the various sectors. And look here, everything is red over the last month. Well, that makes sense because everything has been dropping. The most bearish sector over the last month, energy. Then we can go 5 days. The most bearish sector over the last 5 days, last trading week, energy by far. Friday, the last day, the most bearish sector was energy. Is there any doubt in anybody's mind that this is a really great place for us to go with the US dollar? And it's all of the things I've said. Energy is easily the most bearish sector at the moment. So why don't we come in and snipe some energy stocks? Okay. Now let's look over the last 5 days, let's say. Actually, I'm going to do it this way. I want to see which energy stock took it on the chin the hardest on Friday. This is Friday, 1 day of data. This is Friday. And when I click XLE here, you can see this stocks. And if you can click here by percent change, and you can see the most bearish stocks. You should write all of these down. APA, Marathon, Diamondback, which is FANG. This is APA, this is MRO, this is FANG, this is AHAL. So those are some low-hanging fruit. Now, I don't know that they'll have any company-specific news. You know, I like to see things like, you know, what happened to FedEx. Oh, our inflation is so bad, our demand has dropped for our product, and we're going to lower our earnings estimate. That's really bad news and ideal news, actually, for a bearish credit spread. But here across the board, this is an energy bad news with the strength of the US dollar. So those are really good opportunities. And then if you want to get into a different view, you can go to sector heat map here. And you can see on Friday, all the sectors in a heat map. Let me zoom out a little bit. There we go. So these are sectors. The size of the box is the size of the sector, the component stocks, the market cap. Anyway, the size of the company as it's worth on the stock market. So the size of this box is the biggest because the component stocks comprise the largest amount of market cap amongst these sectors. So what you can see clearly here, a different way to view it is energy on Friday was the most bearish sector. So let's click that. And then what you see is the brighter the red, by the way, the more bearish the sector. So you can see right here, very clearly, the most bearish sector stocks in the XLE energy sector, Marathon, Apache. Okay, so that's where we want to go. We want to go looking at energy stocks. I want to show you this cool article that Andrew wrote. If you haven't gotten to the boards yet, please, you've got an email, please get in. The board is filling up. We're getting lots of cool stuff here. Andrew Taylor, who is our grandmaster of all things communications. We call him what are we calling you now? The chief communication officer, first mate, whatever. But Andrew is really good with his knowledge and his level of contribution. And you can see here, there's a post right here, how to create a list in Tom's tools. Is this a video? Dude. Oh, Paul did that. Oh, no, okay, I'm sorry. That's Jay's video. So there's a post here. Yeah, this is great. This is beautiful. So here we have Andrew's given us the screenshots on how to move through and find and paste all of the component stocks and create a list in Tom's tools. And then there's also a video that Paul put up there as well. Thank you, Paul, for doing that. So I'm not going to do this. I've already done it. And I have a list in Tom's tools that I built using what's right in the boards here, how to create a list in TTR. So it's on the boards. Go get it. Go look at it. Watch it. Figure it out. It's really easy, actually. And then if I go to, where's my pointer? There it is. If I go to website lists, edit list, you know, this is where you can build 20 different lists. And look here, I already have XLE stocks. And here they are. There's 22 of them. And these are the very stocks that are right here in this list. Okay, so I already have the list. This is the most bearish sector. So now what I want to do is go look for credit spreads. So let's go to searchers, single strategy, call credit spreads. We teach this in the hedge fund course, but it's available to everybody. It's actually a general scan in Tom's tools. So two places we could look. You know, we can go short term, get aggressive. I think I want to do both of these, by the way. We'll come back to short term, but even long term out of the money credit spreads are a good idea. And I would say pretty much against the entire market because everything's bearish. But just to illustrate the point, I could say, all right, I want to look for long term out of the money call credit spreads on the worst performing stocks on the worst performing sector in a very badly performing market, and then hit search. And let's see what comes up here. Here they are. Now what this search will do, wow, this is good here on Chevron. We'll have to see what it's doing currently on the market. So what the scanner does is rank the results by probability of profit, statistical probability of profit. That's what it's going to rank them by. And then you have your, your maximum return on investment. So what this is saying right here on Chevron is that you have an 83% chance of making 15% on Chevron with this credit spread, selling the December 16, 170, 175 call spread. That's a credit spread. We'll look at it in a minute. And then what you want to do is take a look at the stock chart a little bit. You can do it right here on the screen.
Mike, look at the CVX below at number 4.
Right here.
Yeah.
Yeah. Say some more. I'm not sure why you like that one better.
Well, I'm just saying that while the probability of profit is a little bit lower, the amount of profit looks like it's higher, isn't it?
Yeah, that's the thing. I'm probably gonna think about moving this further away. So this one, you're selling the 170. Let me pull up a stock chart. I'll go back and forth. It'll be faster this way. Let's go to Chevron. 5 minutes, the market opens. Woohoo! So here's how it works, right? So the 170 call, let me show you the risk graph real quick. Here's your 170. Oh my God, I love this now. There's nothing we have to move on this one, I don't think. But so this 170 call spread makes money essentially below 170, just loosely said. As long as the stock stays below 170, we can make 15%. This one though, yeah, you can make 35%. Yeah, but your probability of profit is about 10 points less. So you have less chance of making it. Why is that the case? Because the break even is closer. All right, so there is this relationship, Brent. The closer you get to the heat being the stock price, the more you'll make, but you'll make it with less probability of profit. That's always the relationship with credit spreads. If you were really convicted that CVX was going to drop from here, you could come and sell right here at 150 and get a whole lot more money, but have a lot less probability of profit. Now, is there a best one? No. It's all about what your appetite is for risk. The idea of these long-term credits is to set them and forget them for the most part. You know, that's the idea. And so for me, I'm less interested in 35%. I'm most interested in not losing. And so I'll take less credit for that. And this is also a valid, let's call it a valid trade. If you're convicted that the stock isn't going to get up to 160, yeah, go for more profit. I like to not lose.
So you're saying that would probably be a better short, if we went to a shorter term, that would be better.
Yeah, shorter term is going to have similar data here. We'll do a short term one here in a minute. But Chevron to me is really a good looking trade. And why do I say that? Well, let's use the actual charting in Tom's tools. I'm going to duplicate this tab here and let's pull up a chart. I know everybody can see this, stocks, charts, stock charts. And I'm going to put on some moving averages, maybe Fibonacci. I love Fibonacci. I like the math, but man, I don't need it. Look, the short strike that we're selling, which is 170 right there, there's a short strike, is way up here. Look, so for us to get into trouble, and by the way, the stock tanked below the 200-day moving average on elevated volume. Boom. Technically speaking, without any of this analysis, this would be a great trade because the stock has plummeted beneath the 200-day average on well above average, twice, 2.5 times the average volume. So even without, you know, bearish market, US dollar, oil's tanking, all of that extra analysis we've done, this would be a great trade. So given that this just happened, a massive gap and close towards the low of the day beneath the 200-day average, says, man, I feel, you know, 170, no brainer, man. I'm into that one. Now, if you wanted to get closer and sell 165, that would be a good level as well. So I'm going to lean, especially a lot of you being novices, I'm going to lean on probability. And so this is a beautiful trade that came right out of the scanners with some basic analysis. Now, one thing I like to do is, and this is an adjustment, those of you in the earnings coaching, at least half of you are now back testing iron condors. And I'm going to give you a precursor to putting yourself in a situation where you have the ability to reduce your risk dramatically with a simple adjustment. And to set yourself up for that adjustment, what we're going to do is widen the credit spread such that there's an extra strike between the short call and the long call. So I'm going to right click this trade, this tab, duplicate it, and I'm going to show you the differences here. So I'm going to edit this trade and I'm going to sell the 180, buy the 180, and we're off. I got to go look here in a minute. Risk graph. So this trade offers only 12, well, still high, 12.68% potential return on investment. This one offering 15.47% return on investment. So when you widen the spreads, the reason we're doing it is in the event that CVX starts rising up to our risk part of the risk graph, we will tighten up this credit. We'll drop the 180 call down to 175, and that
Mike?
will have the, hold on a minute, let me finish the point. And that will have the effect of reducing that max risk dramatically. Yeah, Johnny.
When you look at Thinkorswim, they have 175, 177.5, 172.5.
Oh, good. I didn't even look. I made an assumption. So what you're saying is there's a 172.50 call here?
Yes.
Beautiful. If you want to know what that is, you can go into edit here, right in Tom's tools, look for December 16, scroll down. Thank you, Johnny. I appreciate that. December 16, and I'm not seeing them here in Tom's tools. Let's go into Thinkorswim, CVX. Make sure I got the right expiration. December 16. I don't see them here in Tom's tools, but let's check Thinkorswim. Let's go to December 16. There we go. Yeah, I'm not seeing them in Thinkorswim. Are you on the right expiration date, December 16? Yeah, I'm not seeing them.
Well, I guess when I was trying to move it out, it came up. I thought that meant it was there.
Sometimes when you edit the trade, it gives you strikes that aren't available.
Yeah, my bad.
Yeah. No worries, man. This is what this is, man. We want to. So anyway, I'm going to put it back to 180. This is what I'm going to do. This is our trade for today. One of them anyway. There's going to be, there's so many trades. You know, when I see the markets doing this, I kind of have this feeling of greed. Like I want to grab all the best opportunities. There's a lot right now. There's everything's dropping, and there's lots of opportunities. So this is one way to, when there's so much opportunity, to narrow in on what I think is probably the biggest sweet spot in this bearish market, which is energy. So here we go. This is the trade. We're going to separate it by one strike. And if it comes time to what we call in the hedge fund community, batten down the hatches, squeeze the risk out, contract the spread, drop the 180 down to 175, and really crush this risk here, that's going to be there in our future. So we have that capability. It's about risk management. And if your job, and you really get it, that your job, not only understand, but you are doing it like it is your commitment and your stand to manage risk. When you get there, and chances are you're not, because I thought I was for years, and I've only just over the last 5 years taken that in, where I don't take a chance. If there's risk, I can reduce it, I do it. And so that's the game we're playing now, and this will set us up for that. So let's see what we got going on in the markets as I speak. What is up? What is up? All right, lower low on Chevron. Good, good, good. Let's take a look at the overall markets here. What's the E-minis doing? All right, maybe we get a bounce. I don't know. Too early to tell. We're lower for the day, but the futures have been lower. Let's go to the SPYs, which will reflect gaps. The futures don't. And same general pattern. That's a hammer pattern that happened on Friday on the SPYs, suggesting maybe there's a bullish run here in the future, but so far we're down. We're pretty flat. We're down 0.04% at the moment. So too early to tell there. I'm not going to look at much else. Let's look at the VIX. Let's look at the live stuff now. The VIX is has risen. It's coming. It's higher. It's definitely higher from Friday, up around 32. Let's see. That's all I want to talk about there. All right, let's go after Chevron. So again, on Chevron, what we're doing is we're going to sell. We're going to make money anywhere below that point there. Probability of profit is about 83, 84%. That's going to work. And that doesn't take into account resistance at the 200-day average at the top of that bar. That's one resistance. Two resistance to 200, which is the purple line, also corresponds to 150. That's a third resistance level. We've got 155, a fourth resistance level, 160, fifth resistance level, 165 is at 7, 8 resistance levels that the stock has to bust back above for us to get into trouble on this trade. So that is, in my mind, a really good looking trade. So let's go build the trade in Thinkorswim. So this is what I want. I want the December 16, 170, 180 call spread. Go to trade. There's my December 16. Now I can build this one at a time, but what I like to do in Thinkorswim is turn on the option table view called vertical. You do that right here. It says spread vertical, and then you get pairs of trades. So right here, I can see I've got the 170, 175 short call spread. Right now, the slippage is quite wide. Let me check this slippage as it was. Yeah, 20. Yeah, it's a little hot right now, the slippage, but I'm not worried. If the stock starts to recover, slippage on this big bellwether stock will be okay. I'm not worried about it. Now, the other thing that I like when I place these kinds of trades is, let me just tell you what I did. So I want to sell the spread, the 170, 175 credit spread. I've got the bid price and the ask price. It's quite wide at the moment. That's okay. That's an opportunity. I'll tell you why in a minute. I'm going to click the bid, and that will generate the selling 10 of the Chevron 170 calls, buying 10 of the 175 calls. Now I want a double strike. So I'll take, and this is what Johnny was referring to. The 170, 750s aren't available. So I'll make it 180, take it down to one contract. And that's going to give me $1.24 credit mid price, which is higher. That's weird. Well, not weird. It's because IV's coming in. That the credit today with Chevron even down is higher than it was on Friday. Why? Why? Well, it's because of IV. IV's rushing in. The news is out. So if you want to estimate what this 124 credit would do for us in Tom's Tools, because Tom's Tools is not live yet, is I can take this credit here of 124 and go back into the trade 124 and then 0. So this is selling this spread for a net credit of $1.24. All right, it's the same result as putting in the exact legs, and that way I can see even more clearly what this, if filled up at this price, what my risk graph would look like. 14.16%, 124 credit, max risk 876, probability of profit almost 84%. And again, that doesn't take into account the weakest stock, one of the weakest stocks in the weakest sector, bearish market, US dollar rising, driving commodity price, all that stuff increases this probability of profit. Okay, so this is really sniping. So it's what it is. We're sniping profits. Now, let's see. Now it's down to 120. That's okay. Let me put it in for 120 here. And let's just get a live fill on this bad boy. All right, so mid price is 119. Confirm and send. I'll take $1.15 on this. I'm not worried about it, but let's see what we can get. So I'm going to set the price at slightly higher than the mid price, and I'm going to go fishing. Market maker, will you please give me $1.20 per contract on this spread? Send it, monitor. Well, it's at $1.1950. All right. Not so far. I could leave this today all day. I could leave it for a few days and see if I could get $1.20. You will if Chevron rises over the next handful of days. No rush to get into these things. You can wait. The current mid price is $1.17. So what I'm going to do now is go in to the trade and drop my price. All right, you're not going to give me 120. What about 117? I hit this little button there and cancel replace, and then I'll just drop my price. This is price shopping is what we're doing. 117 mid price. Given the natural 71 cents, I don't know we're going to get it, but we can try. And we got it. We got it for $1. Let me see what we got it for. $1. All right. So Thinkorswim gave us $1.18. Okay. So 212.94. I'm going to populate that in Tom's tools. 212.94. I'm conscious I might be moving a little fast for some of you. But on Wednesday, I won't be at the group coaching. So this is about moving through me speaking out loud and getting trades filled. So this is filled. This is a filled order. The next thing I'm going to post this on the boards here in a minute. The next step, the way you manage these credit spreads, everybody, is the instant you are in, we are for $1.18, $1.18 per contract for 100 shares controlled. That's $118 of credit. All right. So I want to put an order in to buy this spread back as a good till cancel order, a GTC, for 10% of the original credit. So that would be, let's round it up to 12 cents. Now, why would I do that? Well, here's the deal. It's going to take you're going to pretty much have to hold this close to expiration unless the stock drops. And while you have your 90% of your max profit in the bag, and you can only make another, what, 16 cents. No, not even 12. But yeah, you're waiting for $12 while holding up $882 of margin. And what this does is it gets you out of the trade the instant you capture 90% of your original credit by buying it back for 10% of what you sold it for. That captures 90% and frees up your margin and reduces your hold time from something like 3 months down to 45 days. All right, so all of you that are in the hedge fund course, you know all this. Some of our students and snipers don't know this, which is why I'm reviewing it. So that's the first rule I want to distinguish. So let's do that real quick. I'll talk about loss management here in a minute. And then I go back into my Thinkorswim. And because I sold for $1.18, I want to put a GTC order in to buy the spread back for 12 cents. All right, here's how you do that. I'm going to find CVX. And so here's my position statement under monitor. I find CVX, expand the menu. Here's the legs, click, control, click to highlight both, right click, create closing order, grab the first one, and then simply make this a GTC. Time and force is good till cancel. And then let's make this 0.12. So this is a GTC order to buy the spread back. Sits out there. The instant you can get 12 cents buying it back, you'll capture 90% of your max profit in the trade and you're out and on to the next one. So that is the profit stop, the plain vanilla exit. Loss exit is if the stock, and we're going to refine this later, but for now, the stop loss is if the stock closes above this blue line here, this light blue line, which happens to be 171.18. That's our upside break even at expiration. If that happens, close the spread down. Okay, so when the stock closes above 171.18, then you close down this spread for a loss. What's the loss going to be? It depends when it happens. Okay, now let me pause to see if there's any questions about any of that or comments.
Yeah, Mike,
Yeah.
To avoid any confusion, I'm sure you were so excited with the trade, and you mentioned we will have a Wednesday group coaching for snipers, and we won't.
Oh, that's right. I'm sorry.
Just to
So we're
avoid
going to do it
any-
right now.
Yeah.
But we will, as we get to the stage where we begin, if we do get to a place where this trade starts losing, we're going to be adjusting it, and I'll reveal that in this call on Mondays in the future if we need to.
Mike,
Other
just
question?
sorry, just a quick question. When you talk about putting it on the boards, are you talking about WhatsApp? Which boards are you referring to?
I'm going to do it right now. So I'm going to copy this trade here in the MW Trade Coaching Community Board under snipers. And I'm going to set a new topic. And this is going to be a trade. So I do sniper trade ideas. I need to learn how to use my own system. All right, this is going to be the CVX bear long-term bear call. And then from here, I can just paste it right in here. All right, now I'm going to show you the risk graph too, so you can see that. Here's the risk graph. This is filled. We are tracking it. Let's grab it. I'm using my Mac has a screen capturing capability. That's all I'm using here. And then I'll post that there. And move my stick. There we go. And then create the topic. So there you go. That's where we're going to be posting our trades. So if you're not yet in the new improved Mastermind Community Forum, please do yourself a favor and go through the process to get signed up. Everybody out there has an email on how to do it.
How far would you chase this trade if you were trying to get in? Initially, mine was at 124, and then it started moving, and then I've been chasing it. This is on live.
Mm-hmm.
So how far would you chase it?
Well, originally it came up on the scanners as $1.12. So I would go down to $1. Let me see, that's the wrong one. Let me redo it here. This is what the Friday's price was. I would be happy to take Friday's price, and that price was $1. Let's call it $1.13.
Same,
So
Mike,
$1.10 would be the minimum, I'd say.
Mike, I'm trading it live on Think and Swim, and right now it's at 0.98, and I have it at 110.
Yeah, I would just leave it. I would say leave it there. Rerun the scan again at the top of the hour in 13 minutes. When 10 o'clock hits, you'll get new data in Tom's tools, and then go up. Don't get too crazy about the credit. We're talking about pennies for the most part, so don't get too crazy. And again, there's new trades that'll be there every day on this one most likely, and Chevron just needs to bounce up a little bit and you'll get more credit. So just give yourself time. There's no real rush to get into this trade. We're going so far out in time, we're getting lots of time value, so it'll be fine. I would say $1.10 is where I'd want to be on this one. The other thing I'll point out is if you think that 888 is too much for you as risk, then simply take the original trade right out of Tom's tools. And that's the 170, 175. So instead of buying the 180, buy the 175. That'll collapse your risk at $433. Okay, with 12 minutes. Go ahead.
Jova is having a question about your thoughts about the line of the trade, because the rule you have shown us, it's about up to 45 days trades from memory. Wouldn't this trade break the rule?
This is a different strategy. This is a long-term credit spread. The reason that this is a hedge fund strategy, and it's the first one we teach, because it is offers exceptionally high probability of profit. And in the back tests that I've seen done, many back tests, the average return or APL percentage is about 11%. So this is one of those strategies. It's somewhat like an investment strategy where you throw on these trades out into the future by 3 months, or give or take a week or two, and then you let them and you set them and forget them. Good, 85, 90% of them are going to be profitable in a normal market. And in this market, the bears will work really well, and your APL will be about 11%. So that is one approach. This is not the sniper approach. The sniper approach is this one. So you want to get closer to the heat. Then what we'll do now is rerun the scanner. So we've got a long term. One thing I need to do here is, now that we're filled on this trade. Yep, this is the one. This is a long-term bear call. I'm going to save this in our Sniper Live folder, and we're going to track it. Trade, and then what I'll do next is put it. That's all I'm going to do for. I don't have portfolio set up yet. So now this
Change
trade.
the name to 170, 170, 180.
Yeah, thank you. Good point.
Mike, can I ask one thing, following up on what Johnny said earlier and what you just mentioned? With the strikes, he found that there was that 172.50 for the earlier months, earlier times. For December 16th, we could not find them. At what time will they add extra strikes if need be, or once a month is set, they don't add any extras? How does that work?
That'll probably happen if you can get a clue by looking at the option chain. So it's currently 26th of September. If I go to the next month, all right, so this is 25 days away. You can see all the strikes that Johnny was talking about. If I go to the next month, which is the next week, which is the 28th, you'll see them there. This will give you a clue as to the lead time for the extra strikes. And I like that you asked that, because provided it takes a while for the stock to rise. Now here you can see there's only 5-point strikes. This is on November, but all the way to November, which is 40 days away, there are a lot more strikes. Okay, so that's 40 days. So given that, I would say that when we get to about 40 days, but after the 30-day options expire, the next 30 days, then you'll start to see strikes. So as long as the stock doesn't rise in the next 40 days, you will see these other strikes appear as we get closer.
Don't those strikes go with the weeklies?
Yeah, they show up on the monthlies as well when you get close to the expiration. So what that means is you could take this one on. As the only thing that you have to deal with is if oil starts spiking, then you may not have the contraction strikes. Chances of that I think are slim though, Paul. So that's a good point. So if you are one that wants to play with the contraction later, as long as the oil doesn't recover in the next, let's call it 40 days, then you will have a 172.50 call, maybe in about 40 days, but now not. So this is a good alternative as well. Selling the 170, 175. I just don't see oil back up. I got to be careful when I say stuff like that, because I'm wrong sometimes. If you look at the markets rising recently, I was wrong about that. So it's possible. So good question.
Thank you.
Yeah, really good question. Thank you. All right, let's go looking for a sniper. Short term, more aggressive, more return, more chance of losing. Search XLE stocks. So all I did here was notice short term. Okay. And one thing that this scanner does, this is actually, I'll give you some background on this scanner. It started off as a sniper scanner. During COVID, I had this system where I looked for stocks that were dropping, and then I would sell credit spreads at resistance, just like I showed you the rules earlier. And so here, this is the default. And what this scanner does is it actually uses stock close percent change. That's another scanner, but it's built in. And it looks for the stocks that have dropped the most over a 1-day period. All right, so it's already looking for the train wrecks. And then forget about all that, but that's what it's doing. I'm going to go to short term and click search. What do we got here? So these are the oil companies that have come up on the list. And Brent, you'll notice that the returns are higher, a lot higher. Here's one for 50%. Probability of making 50%, about 70%. So probabilities of profit are generally going to be less than 80. What's interesting on these here is this is a 7-day trade, everybody. Look at this. A 7-day trade providing you an 86% chance of making 25% on your money in 7 days. Are you serious? The short strike is 62. So that's your line in the sand. What does that mean? It means that we need the stock to be below 62. What's the chances of that? Well, just start by looking at a pick. Pick 3. 62. 62. 62 is right about where it was on Thursday. All right. So again, we're up against the heat. What I would do on this one, if I wanted a 7-day profit, is I want to sell at resistance. Okay, so 60 is resistance. See that there? 60. Support, support, resistance, 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 support, resistance, resistance at the moment. Selling there would be reasonable. It's a resistance level. Selling here at 65 for me would be, well, to get in trouble, the stock's going to have to close above 60, one resistance level. You can make a case for 62.50 as well. Let's call that a second resistance level. I lost my chart now. Let me redo it. Okay, so we got resistance, resistance, 2, resistance at 65, mega strong resistance at 65. That's 3, and then the 50-day average 4. So that's where I would sell. And you could look through the list and see if it gives you a 65. It doesn't. Let's just compare the two trades. I'm going to check a couple more though. Let's look at ExxonMobil. Yeah. Okay, this one's okay. The short strike on Exxon is at 89. Let's call it close to 90, which is right about here. What I don't like about this one is there's a level of protection. There's support at 85 and there's support at the 200. Given that the stock's at the 200, I could see it bouncing. So I don't want that. I want there to be free fall. I don't want anything stopping the stock from dropping. Here, there's plenty more room for Occidental to drop down to 55 and the 200-day average. All right, so let's look at a couple more. MPC, similar chart. They're all going to be very similar. And this is one of the things you got to also remember is you don't want to like put on 3 or, more than 1, maybe 2, but let's just say 1 stock in any sector because they all move together. Okay, so let's go after this Oxy one here. 7-day trade, goodness, that's amazing.
Mike, is this still Fridays?
It's still Fridays, yeah. We don't get
Well,
today.
we're about there now. Is it worth refreshing?
Not until 10 o'clock. It's 2 minutes till. But what I've been doing, and on the last trade is I'm just going to take a look. Okay, so this one's offering 25% over the next 7 days, but selling really close. What if we sold the 65? Let's lift it up, take less credit in exchange for more probability. And I'm going to edit the trade and sell 65. And again, my 2-strike rule, 67. So we can contract later if we need to. Let's see what it gives us.
Mike, excuse me. Oxy is down right now by 0.90%.
Yeah, I'll look at it in a minute. I got you. I understand. Just going through the process. So 65 is a good place to sell. Not a whole lot of premium. We got about 2 minutes. I'll rerun the scan in 2 minutes. Let's just pause and look at the markets and I'll rerun the scan. We'll go a little bit longer today. Oxy. Yeah, it's down. Looks like it's bouncing off 57.50. Not that material. If the IV is coming in, it should be fine. So this is where I'd like to sell on Oxy short term, right up here at 65. Let's look at the markets. What are they doing? I'm riffing for a minute. Lower low, little hammer pattern forming. Bonds down a little bit. Rising interest rates. What's the US dollar doing? That's important. Oh, what was that word? What was that word that Bloomberg used? Hideous. That is hideous for this stock market and commodities in particular. So US dollar is getting even stronger. Gold even weaker. Although it seems like it might be bouncing. This could be, gold is up. It's flat, it's down 0.1%. But if that hammer holds and this gold starts rising while the US dollar is horrendously rising, then we could see a sign of risk off. Why is that important? That strengthens our bearish prognosis on the overall market. Now, one thing I'll do before we rerun the scans here, let's take a look at our portfolio now. So these are the open trades that we've done since we started, and we're ringing the bell everywhere. Let's move through these quickly. On the Qualcomm trade, we placed that on the 12th, 2 weeks ago. This one is approaching our 10% buyback rule. So if you have this one on, be sure to set your GTC buyback at 10% of your original credit. Good till cancel. We're almost there. We're almost there. All right. So that one's looking good. We have one on Chevron that's currently on. We just placed it. Here's one on Texas Instruments. I decided I marked this one as, you really shouldn't do it because it's in the same sector as Qualcomm, but I just wanted to track it. It's a really beautiful example of a long-term credit where you're selling. Our break even is at recent highs. So for us to get into trouble on this one, the stock's going to have to set new highs. Not likely in this current market environment. IWM, we placed this one on the 16th. Yeah, beautiful. Again, nearing the 10% buyback in just a couple of weeks. All right, so we're batting 100 or 1,000 right now. IWM, Qualcomm, and then of course Chevron. So there's I'm telling you, this strategy in this market is the best. Let me give you one little piece of good news about these trades. So let's just go back to this one. Okay, so this one was filled live. The IV is elevated. Let's go to the latest date here to get the current data on this one. See, the data is now live from 10 o'clock. I just hit the latest button to refresh. So I want to see the IV. Here's the IV. All right, so it has spiked up on these options. Now, what's going to happen is if the stock does recover and starts rising, what's going to happen to implied volatility? Well, it's going to drop. And what does our Vegas say about that? Oh, yes, please. So what does it mean in layman's terms? The icing on the cake of bear call spreads in a crashing market is that in the event there's a recovery, then you'll lose less money because the IV will come out sucking these lines towards profit, away from risk towards profit. So these lines will get sucked that way in the event there is a recovery. This is why bear call spreads in this kind of a market is literally like shooting fish in a barrel. Everything's lined up. The Greeks are lined up beautifully, especially on the IV front. Okay, now let's run our credit spread scanner again. Hit the latest date here. See, right here it says 9/23/532. That's the latest data stamp. And then if I hit latest, it'll take us to, and you have to do it twice sometimes. There we go. So now we're at 9/26 and the timestamp is 10:01. That's when the new data comes. So let's rerun this scan for short term and see what we find here. There's Oxy right on the top of the list. We already have a long term. Yeah, I got short term. So Oxy is also a short term credit spread as well. Oh, we don't have Oxy. Excuse me. I got confused there. So we've got Oxy is one. Let's see. This is the one we want. Yeah, this is the one we want. It's still good. Now the short strike is lower because the stock has dropped. But there's 4-day trade. What? Okay. All right. Anybody interested in making potentially 30% by Friday? Huh? Anybody?
Yeah.
Anybody?
Yeah.
I am. What has two thumbs and likes making money in 4 days? This guy. Now we have to get closer. So we got plenty to work with. This is real sniper trading. This is real sniper trading. Let's pull up Oxy, see if there's any news. Oh, well, their former CEO died. Okay, that's not that. That was Friday. So no news as of today on Oxy. It does seem to be finding a little support here, right around 57.50. If I sell up here by Friday, I don't see the stock up there by Friday, but can we get money for it? I don't know. If you want to make 33%, step up to the heat, baby. So if you don't think that the stock's going to be above 60 by Friday, this is an awesome trade. If you're right, but if the stock rises big, you're going to lose. So I'm curious to see, let's go back to Oxy. What could I get if I sold the credit spread up here at 65? I'll get less money, but my probability of profit will be astronomically higher if there's any money there. So I'll duplicate this tab and I'll compare. So the game now becomes, how close do you want to get? Let's go to 65 and 68, 2 strikes between. September 30, that's Friday. Yeah, only 4% at that level. That's gonna be the case if you're only going out a week. So this is really fastball that we're playing. The next thing is, well, how much lower am I willing to go? And I would say maybe, let's say 62.50. 62.50. What do we have before? We had 61. What are my strikes? Let me check my strikes out. September 30. Edit the trade. September 30.
The next fib level is at 63.
63? Okay. Great. We've got 62.50 and 63 and 64. Let's try 60. Well, let's try 63, Andrew. I like that. What can we get though? I hope you guys are getting the sense of this game. There's 12% in the next 4 days at 62, at 63, a fib level. Let me show you the fib level. Duplicate stock charts. And I can come down here, turn on fib, turn off the moving averages so it's cleaner, and hit update. Now you had probably shorter time frame, Andrew, right? 60?
100 days.
100, okay. So let me just replicate what you're seeing. And there's your fib level. Yeah. So I actually like this one. It's the energy of it for me though is I don't do a lot of these anymore. I do broken wing butterflies. And for those of you in the hedge fund, get ready tomorrow. We're gonna be butterflying the heck out of this stuff. But it's really a good looking trade. I would say 63 is a good place to sell. It is a fib level. It's above 62, which is also a really good place to sell because that's the bottom of the gap, right before the gap. So if the gap is filled, 62 will provide a nice level of resistance. But 63 for me is a little safer. It's offering us 12% in the next 4 days. Look at that IV. Guess where this IV is going to be on Friday at 4 p.m. Gone, 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 gone. If the stock recovers, IV will come out, helping us, keeping us safe here. I'm going to go after this one. Let me see what we get filled at. The prices should be pretty close. Oxy, September
Mike?
30. Hold on, let me get through this, man.
Yeah, just wanted to add that 10 moving average is on 62.23, I believe.
Okay. Thank you. So there's more resistance up there. Gosh, just the resistance of the bottom of this 60 is super strong resistance. Also, this isn't technically a volume spike trade, but because the volume wasn't big enough on Friday for it to be a volume spike, this volume would have to be 3 times the average. It's not, but we did set a lower low. We cracked below the low of that day today. So we're going to sell right here at 63. Resistance at 60, resistance at the fib level at 63, resistance at 62, resistance at the 10-day moving average, as Peter just said. Lots of things to keep us safe on this one, safer. So let's see what we can get. I'm going to go into the software, Thinkorswim, go to trade. Short term. I'll tell you guys a story here in a minute. We're going to sell the 63 and buy the 65. I'll take my spread down to vertical so I can quickly do it. Click on the bid price. That creates this here. I'm going to make my upper strike 65. I'll post this once it's filled in the sniper thread. September 30, 63, 65. How many contracts? Let's keep ourselves below 500 on this one. So we could only do 3 to make our max risk slightly less than 500, just slightly over actually. I think that's good. 2 contracts would be under 500, but we're keeping our risk contained in the event there's some kind of snapback. So we'll do 3 contracts. 3. So we're selling 3 Oxy 63 calls for Friday, and we're buying 3 65 calls for Friday, 20-cent credit. Software says 22. Let's go for a bit more. Stock seems to be rising a bit. Let's see if we can get 21.
I just got 21.
You got 21 just now? Okay, good.
Yes.
I hope I can too. Monitor. All right. There we go. Got 21 on it. Sold for 39, bought for 18. Sold for 39. Bought for 18. And let's save it in Sniper Live. And let me change my strikes. 63. I'm going to call this a sniper. Short-term sniper. Update. And believe me, we could sit here all day long finding opportunities in this market, all y'all. It's beautiful market conditions for us right now. So there you go. Let me post that trade in the boards here. There it is. I'll post it, and I'm going to let you ask any questions you have while I'm posting here. What questions do you have? I know some of you are new to credit spreads, and that's pretty much all we've been doing so far in snipers. We'll do other strategies later, but.
Hey, Mike, on these, we don't put the 10% buyback on, right? We just let these expire worthless.
Yeah, I would do the 10% buyback on these as well.
Okay.
Yeah. If you look at what happened with USO on Friday, I had a broken wing butterfly, and I was like, man, USO isn't going to tank by Friday, and in a day it did. So you want to, and Glenn, I didn't buy the put. Had we bought the put, we would have made money without it. We'll talk about it tomorrow, but all right, let me post a new one here, and I'll go back to snipers, and we're going to post a new topic. This is where you're going to see your trades, everybody. And this is the Oxy short-term bear call. And this is a trade idea. So sniper, trade idea, and I'll just paste.
Mike,
So would you do adjustments in within those 4 days?
Adjustments, I wouldn't adjust it unless I would start thinking about adjusting it if the stock broke above 60.
So then why the 2 strikes between?
Because I can in an instant decimate the risk, regardless of when I do it.
Damn it.
What? Somebody said, "Damn it, why?"
Mike,
right.
you're using this instead, and the WhatsApp is no longer being used?
Not for snipers, no. Snipers is ultimately, now it's a free service we're putting out there. And because it's free, we're going to be using the boards. For those that are subscribers, we're doing the WhatsApp. That's the idea. Let me also say on this one, place 10% GTC buyback. And then I'm going to say just generally, because not everybody knows how to adjust yet, exit if Oxy closes greater than the break even, which is 63.21. Not very likely by Friday, but it could happen. It could happen. There you go. Okay. Do we have any questions in chat that we need to deal with, Gerardo? Dean got $1.25. Okay. $1.10 credit. All right. Now the thing about these fills is, we got filled on all of them today. No, with Chevron, we're still waiting. No, I'm sorry. Those are the buybacks. Excuse me. So we got Oxy, we got Chevron today, and there's plenty more. There's plenty more. I would say another thing you want to start doing is just see what's available. I'd say long term, unless you're experienced credit spread traders, we have this in for a reason. Go after the entire universe right now, and just see, here's the other side of finding opportunities is, let me just go look for all long-term out of the money call credits on everything that's got options, hit search, and then just kind of go through the best option trades based sorted by probability of profit, and look through those and pick the best of those. So we're letting the option, what's available in the options, guide our selection process. So when you get your list back, then it's about going through these stocks. This one on KRE, John knows about KRE, it's banking. This one is offering a 86%, almost a 9, well, it's close, well, 90 is really good. 86.81 is almost there. 20% chance of making 86% with the stock staying below 69. Pick, where's 69? It's right up here. 70 on this one? Yeah. Oh, we got to do this one. All right, one more. There's a lot. There's a lot of them, everybody. It appeals to my I love this stuff, man. It's really cool. All right, let's edit the trade, give us ourselves an extra shot. I'm going to lift it up to 70, round number, above recent highs. It's in a different sector. Risk graph. 13%, 13.64% probability of profit. Almost 90%. What? And for us to get into trouble, banks are going to have to put up let's get a bigger chart here. KRE. Look, let me show you where 70 is on the chart. So 70 is up here. The last time regional banks were above 70 was March 30th of this year. So that's quite a few months. So for us to get into trouble, banks are going to have to recover strong in the next 3 months or so, which is quite possible. Here's the other thing about banks is, with rising interest rates, ultimately that's good for their business in terms of margins, but again, their business is also impacted by business and the health of businesses. So you will, currently banks are moving with the market, but there is going to be a point at which banks will perhaps start getting stronger. So that's a little caveat. And here's the trade. Let's go get it. Going to sell the December 16, 70 trade, December 6, 15, December 16, excuse me, verticals. And I want the 70, which is here. Click sell, lift the upper strike. All right, 24-cent credit, mid price. That's what the software says. Tom's tool says. Yeah, let's try to get 24 cents. How many contracts do I want to do? Move my zoom window out of the way again. 176. Let's do three of these as well. Risk graph. All right. So 3 contracts and 24-cent credit. Confirm and send. Send. Monitor. Not giving me 24 cents. Yeah, we got it. We got it for 24 cents. I go back to monitor and get my price. It's 58 cents, 34 cents on the fill. That's exactly what Tom's tool says. So this is a long-term bear call. Save it. I'll post it in the board after we finish here. And there is another. Now, of course, you want to, once you've gotten these orders filled, and I didn't do it for the Oxy trade, I'll do it now. But as soon as you're filled, you've got to do this, right? You know, I'm going to put the 10% buyback on KRE. 10% of what? 10% of 24 cents. Let's make that 3 cents. So I come to KRE. There it is. Click each leg. Click. Control click. Right click. Create closing order. 3 cents. Good till cancel. 0.03. Good till cancel. Now, listen, everybody. I know that not everybody has Thinkorswim, but just fill out the form as I'm generating it in Thinkorswim. It's the same thing. This is your form for a form-based broker. So don't. I'm just hopeful that people aren't getting frustrated because I'm moving through Thinkorswim. But this is my live fill environment, so that's why I use it. All right, and the other one that I didn't do was the one on KRE that we just filled, and same thing. Let's do that 3 cents. What did I just do? I just did KRE. I got to do Oxy. I haven't done Oxy. That's what I haven't done. Oxy we got for 21 cents. So I'm going to put an order in to buy this one back for 2. It's my rules. Oxy. Click each leg. Expand. Click each leg. Click. Control click. Right click. Create closing order. Make it 2 cents. Good till cancel. Good till cancel, confirm and send. And at least from a profit standpoint, all 3 of the trades we just placed today and we're filled today are running on autopilot. I want to keep going, but I got other things I got to do today. But it's prime time. It's prime time credit spread season, everybody. The other thing I like to do right now is look for big move stocks. All right, you can do that in checking the news, find the stocks that are tanking the most. If you have Thinkorswim, you can get a live view under watch list here. I've got different watch lists. This is my futures list. If I click the list, I can go to top 10 losses on the NASDAQ. So this is this is ambulance chasing, quite frankly. Let's find the biggest train wrecks. Here's one on EXLS, and I can start. Look at that. So this is EXL Service Holdings. It tanked today. Today it just did it. Why? Well, let's find out. Let's see if we can find no news for today. That's interesting. I don't see any news on it. So what I'd want to do here to implement snipers is I want to find what the bad news is. Something dropped it. It dropped here on Friday, and then it dropped even more today. And yet I don't see any news yet. Let's do So that's the NASDAQ top 10 losses on the New York. You can also run Tom's scanner and find these. I just like to look live. So I look there, none on the New York. You can also do analyst downgrades, looking for the train wrecks. None there. All right, I'm going to stop because I'll keep going, and I know that other people have other things to do. That you all have other things to do besides listen to me riff all day. All right, what questions or comments can we wrap up for today? Anything that anybody'd like to share? Andrew got filled at 22 cents on the Oxy. Good job, Andrew. September 30, let's keep an eye on that one.
Yeah, I can now see why Warren Buffett gets excited in these environments.
Yeah. You know, Dean, what have you heard? You probably heard the saying, he says, I'm greedy when others are fearful and fearful when others are greedy. Okay, Giovanni has a question. Your thought about the length of that trade. The rule you have shown us is about 45 days. So I'm not sure which trade you're talking about there.
We already talked about that.
We did talk about that. Okay.
Yeah.
Have I missed anything, Gerardo?
Not that I think. Good job.
I love these markets. It's I got to be careful and not get you too excited, but probability is on our side. So let's profit, shall we?
Mike, I have one quick question, and I don't know if snipers is really the way to cover it, but or the environment, but your UVXY, I know it gapped up big, and I believe you had a broken wing butterfly on that one. Is there any risk that it's going to penetrate your break even?
Yeah,
because it's gapped so high.
Yeah, what I did on Friday was I tightened the upper strike to make it balanced for now. Yeah, I did that on Friday, but yeah, you want to go delta neutral on the red line, and the safest thing to do now is to tighten the upper strike, drop your risk, and then readjust once the UVXY starts moving in a different direction or a particular direction. Yeah, you're welcome. We'll cover that tomorrow as well, Dean. Giovanni's going to sleep. It's 12:30 in the morning for him. Go, buddy. Good to have you here, man. Thanks for staying up. Hope you enjoyed that. All right, with that, any last questions before we wrap today? Anybody? All right, well, those of you in earnings mastery coaching, we have not sniper, we have 1-on-5
last little bit of weather out here.
Let's see, hurricane. Paul, I used to get really excited when hurricanes came when I lived in Florida. It's amazing that, you know, what you really understand when hurricanes hit is that the world stops. The world stops. No cars on the highway. We stop working. We stop everything. And it's possible that we slow down. I always get that on hurricanes. So are you in any jeopardy, Paul?
Say that again.
Are you in any jeopardy? Are you worried about?
Oh, no. It's past us now. I think our big concerns will be for the Gulf Coast in Florida.
Yeah.
Because this thing is just building into something huge, and Tampa, Sarasota, all those places are really at risk. But
and that's where Tom lives.
Yeah.
So I have a feeling I might be doing more webinars this week.
Yeah. He better have the crew putting the plywood on the windows.
Yeah. Well, I'm gonna call him today and see how he's doing.
Thanks for today, guys. It was great.
Yeah, thanks everybody. Thanks for being here, and we will see you all soon. Pura vida.
Thanks everyone. Bye.
Thanks, Mike. Thanks,
Bye,
everyone.
everybody. Thank you.